Hey, I'm Michael Smith, CEO of Bluefield Realty Group, and we're going to spend a third week now talking about interest rates. It's all over the news. There's a lot of misconceptions and misunderstandings out there, so I really want to break down the mechanics a little bit, help you understand what actually causes mortgage rates to go up and down. So first of all, let's talk about last week on March 3rd. The Fed announced an emergency rate cut for their federal funds rate. They dropped it from 1.75 to 1.25, which was a half-point decrease. And a lot of people expected mortgage rates to drop half a point as well based on that news, but that's really not how it works. So the Fed, when you hear the term thrown around, the Fed cut rates, it doesn't mean that the Fed made mortgage rates go down. What they control is something called the federal funds rate. And that's the rate that the Fed will lend money to banks in order to make sure that they meet their reserve requirements and there's enough liquidity in our financial system. That typically causes a little bit of a ripple effect. Think of it this way. When the cost of money goes down for the bank, they're able to reduce the rate that they charge consumers. It's almost like they're passing the savings along. So they can charge a lower rate on auto loans and personal loans and things like that without losing their profit margin. Just like if the cost of coffee beans were to go down, theoretically Starbucks could drop the cost of their coffee, right, without losing their profitability. So that's the federal funds rate. That's what the Fed controls. Now, that can have a pretty direct impact on adjustable rate mortgages like home equity loans and things like that. But the rates on fixed rate mortgages, they work a little bit differently. Those are really more market driven based on supply and demand in the secondary mortgage market, specifically what's called a mortgage-backed security. So when banks create mortgages and they lend money, they will package those loans up into mortgage-backed securities and resell them to investors on the open market. Individual investors like us, or institutions like big insurance companies, they can choose to put a portion of their investment portfolio into these mortgage-backed securities. It's basically like a bond. They tend to follow very closely to the 10-year Treasury bond. It's not perfect, but if you look at a chart over the long term, there's a little bit of a spread, but they tend to move pretty much in tandem. The yield on a 10-year Treasury note is always going to be a little bit lower just because it's safer. The government will guarantee the Treasury note, but there is a little bit more risk in a mortgage-backed security. So let's talk about what actually causes those yields or those rates to move up and down based on what's going on in the market. Really, it's based on expectations of the future. So when people start to get concerned about the economy as a whole, they think maybe we're going to go into a recession or something like that. They will typically move their money into something safe. So a 10-year Treasury yield is a historically very, very safe financial instrument. You put your money in and you're guaranteed to get a certain interest payment for the next 10 years. Mortgage-backed securities are also pretty predictable and pretty stable. When they're based on fixed-rate mortgages, the investors have a pretty consistent and pretty predictable rate of return while their money is tied up in there. So what causes those to go up? Like I said, it's supply and demand. So when people want to pull their money out of the stock market and they put it into bonds, for example, because they think the bonds will be safer, less risky than the stocks, as more and more people put their money into those bonds, it causes the price of that bond to go up. Now, with bonds, prices and yields are inversely related. What does that mean? It means as the bond price goes up, the yield or the rate of return on that bond will actually go down. And the inverse is true. If people start selling those bonds and pulling their money out of the mortgage-backed securities to put them somewhere else, as the price goes down, the yield will go up. Because remember, the interest payments are fixed. So if you spend less money on something that will give you the same dividend or interest payment, the yield there is going to rise. So as every morning the lenders will look at the market for mortgage-backed securities to kind of determine their pricing for that day. So when the market's open, they can see what investors are willing to pay and what yield investors are expecting for a mortgage-backed security. That gives them an idea of what they can charge. If investors are willing to accept less, that means the mortgage company can lower their rates without impacting their profitability, because the rate that investors are willing to pay in the secondary market determines what they can package up and sell that mortgage for, if that makes sense. All right, so let's recap real quick. Just because the Fed cuts their rate, it doesn't mean mortgage rates are going to continue to go down. That's not what causes rates to change. What causes mortgage rates to change is investors and their expectations of the future. So when people are uncertain about the economy and they think we might go into a recession, rates tend to go down. As investors get more optimistic and they think things are going good, that will cause rates to go up. So what does this really mean for you? Just like we said last week, rates are very low. It's still a great time to buy a house, great time to get yourself locked in on a long-term fixed rate mortgage. And if you don't plan on moving, if you bought your home 18 months ago or so, if you've got a rate in the 4s or 5s, now is a great time to refinance. I know we said that last week, but I really want to harp on that. Now is a great time to refinance. So if you're curious about what this means for you specifically, if you want to reach out to us by phone or email, we'd love to talk with you, maybe get you connected with one of our preferred lenders, and you can explore the option of refinancing or purchasing if you want to talk with one of our agents. At Bluefield Realty Group, we strive to be your guide through the real estate process, minimizing stress and maximizing results. Thanks so much for tuning in, and we'll see you next week.